Welcome to our Hotel Business 7. Today we're talking about our RevSIM report. Here is a picture of our team and the table of content. We'll be starting off with a description of our hotel, our initial strategy, followed by our analysis through the 2 years. We'll be finishing up with our short-term strategy as well as long-term strategy. Our hotels has 200 standards room and 50 premium. It is a 4-star hotel in the city center that opened 9 years ago. Our infrastructure, as of right now, we have a business center, retail shops, travel and tour desk, valet parking, and executive lounge. Concerning our services, we have services that meet the 4-star hotel's need. Initial strategy, we run many as a business hotels. We tended to attract groups for both weekdays and weekends. However, we also wanted to attract transients on weekends to push our sales. We wanted to accommodate our hotels for transients with refurbishments right before the high season in summer. We wanted to opt for a quality and low price hotel to position right under our competitors and then increase our prices once we are known later on. We wanted to accept as many groups as possible, even with a low revenue prediction, which impacted quite our revenue and RevPAR later during the year, and we'll be discussing this over the slides.
We decided to begin by analyzing our RFP management in order to provide a clear understanding about July year 1 and April year 2 performances, which differ greatly from the overall trend of our property. Our initial strategy relied on targeting business travelers and groups. However, we only answered to 4 RFPs about the 8 proposed. Indeed, we have not been enough proactive in proposing RFPs, but that comes for a reason. For the first 2 RFPs in April and June, we decided to offer our MAR 2 times higher. Having understood the intensity of the price competition, we proposed our exact MAR for the July RFP to maximize our occupancy to the detriment of ADR. This strategy turned out to be a failure. During July, our GOP PAR fell slightly, our RevPAR was more than 5% below the competition, and our profit growth slowed. This experience demotivated us to take part in the fierce price competition, which could have further damaged our performance, and decided to focus on transients and business-related travelers. However, in April year 2, we received 3 RFPs offer for 3 teams of athletes from different countries. However, we made again the mistake of proposing our exact MAR. So we received the French team for only $58 per night per room. This low price caused our ADR to drop much more than the increase in our occupancy, contributing to a RevPAR nearly 30% lower than the competition, a negative profit of nearly $90,000 and 54% drop in our GOP PAR. After making the same mistake, we decided not to respond to the last RFP in June. In terms of market share, we can observe that the July year 1 RFP has contributed to a total market share of over 10% for Tro in year 1, and the April year 2 RFP to a market share of over 40% for large group in year 2. Concerning our MAR calculation, we have not been accurate in determining the occupancy forecast. The use of a trend line and the lack of data for previous years prevented us from obtaining the right occupancy rate. The number of displaced transients was therefore inaccurate, resulting in a false MAR. If we had to do it again, computation of a pickup matrix using ROH and pickup would have been much more efficient to determine the occupancy forecast and thus an accurate MAR. Finally, we would have to keep prices 20% higher than our MAR to ensure sustained ADR and good performances.
So next part, I will be the comparison year 1 and year 2 across the key metrics. Let's divide it into numbers. For the OCC rate change, the overall performance for OCC running 18 months and our hotel's occupancy followed by the overall market trend with higher season in the 3rd quarter and lower season in the 4th and the 1st quarter. For the year 1 with higher average of the 64.65, year 2 with a lower average of 5.90, and there is steadily increase from January year 1 to August, indicating a positive growth trend. In year 2, occupancy rate fluctuated, but generally remained lower than year 1. For the ADR trend, generally increasing ADR from January year 1 to August year 1, showing a positive growth trend in pricing. Year 2 starts with a higher ADR in January compared to the January year 1, but experienced a significant drop in April year 2, possibly impacting revenue. For the RevPAR trend, following a similar trend to the occupancy rate and ADR, with a peak in August year 1, followed by a decline until December year 1. Year 2 shows fluctuating RevPAR, with some months like the April in year 2 significantly lower than the previous year. So comparing to the 2 years, year 1 boasts more steadily and predictable growth until dip in performance post-August. Conversely, year 2 exhibit peaks and through cross metrics, leading to an overall inconsistency in our performance. There were months in year 2, especially April, where our ADR and RevPAR were notably weaker compared to the same period in year 1. Despite an increase in OCC in April, the final RevPAR declined due to the decline in ADRs.
Now looking at the revenue analysis of year 1 and year 2. So first of all, we can see that we perceive a steady increase in revenue from January year 1 to August of year 1. So this means that we made a really great development of the hotel at the beginning of our operation. Furthermore, we perceive an important decrease from September year 1 to February year 2, which highlights the low season. Lastly, we had an increase in revenue from May to June of year 2, which also highlights the beginning of high season. Lastly, if we compare the total revenue of year 1 and year 2 from January to June, we see that at the beginning of the years, revenue was better in year 2, but afterwards, revenue for year 1 outpacing the revenue of year 2. So we chose to compare our performance with those of our competitors using RAI, MPI, and NGI. For year 1, we can see that our RGI has always been above 100 for the whole year, apart from July. This means that our RevPAR has always been higher than the average aggregated RevPAR of the hotels in our comp sets over this period. On average, over last year, our RevPAR was around 2.7% higher than our comp sets, demonstrating the good profitability of our establishment compared to the competition. Over year 2, a similar trend is visible, with every month apart from April recording better RevPAR than the competition. However, April's RevPAR was so low at $72 that on average over the first 6 months of year 2, our RevPAR was 2.94% lower than our competitors. Now comes the question of which metric between occupancy and ADR contributed most to boosting our RevPAR. So in January year 1, our high occupancy linked to a low ADR contributed to our good RevPAR. Then from February to April year 1, we opted for a skimming strategy as we were not assured of a good occupancy during this season. And this contributed to a higher RevPAR than the competition. From May to August of year 1, we decided to opt for a matching pricing strategy as we wanted to stimulate occupancy, and this contributed also to a better RevPAR than the competition. From September year 1 to the end of year 2, so June of year 2, we readopted our skimming strategy with higher ADR than the competition, which contributed to a good RevPAR despite lower occupancy than competition. July of year 1 and April of year 2 are special cases as our performance was greatly influenced by RFPs we obtained and we analyzed it before.
So year 1 months like January, February, and March had forecasts close to actual, with difference with a 2 to 3% range. However, in July, the forecast overestimated the actual occupancy by 50%, as actual occupancy is 79% and we forecast is 94%. The discrepancy indicates a significant difference between the expected and actual guest numbers. The next big difference is April year 2. The forecast significantly overestimated the actual occupancy by 27%. For May and June, both months had noticeable difference between actual and forecast rate, particularly May showing a deviation of 11%. For the most accurate month is April year one. We predict the most accurate number, which is 63%. The next accurate month is May year one. The actual occupancy is 66%, and we forecast number is 65%, just 1% floating.
Concerning our reputation management, over those 18 months, we separated rooms and public area refurbishment levels in our property in two different graphs and compared to the ComSet average. Moreover, we completed those line graphs with a bar chart displaying the total refurbishment investment per month in dollar. Focusing on rooms, we managed to have a better refurbishment level than the ComSet for 9 months over the 18th, in March year 1, from October year 1 to March year 2, and after May of year 2. Our strategy relied on pursuing a contract cleaning from premium and standard rooms in February year 1 during the low season to increase quality before the high season. Nevertheless, we should have done these refurbishments later in the year as we reached a low 52% room quality in August in the middle of the high season. This pushes us to invest in room refurbishment in August and September year 1 for better room quality than the ComSets. We then reinvested in room refurbishment in December year 1 and April year 2 when the rate was below 55%. This strategy allows us to keep a room quality between 52 and 62% for lower investments, increasing our available funds. Concerning public spaces, we had a better refurbishment level than the ComSet from August year 1 to January year 2 and March year 2, so during 7 months over the 18th. In April year 1, after only refurbishing the front desk in February, our quality level was down to 53%. We then decided to refurbish all facilities by a contract cleaning in May and June of year 1 to limit cost and increase quality by 10% for each facility. We attained 59% in June and continued to further refurbish the meeting rooms and the lobby in August by soft good redo and renovating entirely the environmental program, which led us to 69% of quality for public spaces in September year 1, our best value for the period. We should have invested in refurbishment earlier in the first quarter of year 1 during the low season to allow us not to refurbish during the high season and not close down some facilities. The end of the period from September year 1 to June year 2 has a fluctuating trends illustrating by the continuous low investment in refurbishment during each month. Lastly, we should have refurbished some public spaces in May year 2, which would have sustained a quality higher than 55% in June. Overall, we should have invested more in refurbishment during the low season at the beginning of year 1, and we managed from August year 1 to June year 2 to be proactive and keep medium quality levels.
Concerning our service and infrastructure analysis, we managed to keep our revenue higher than our expenses, which allowed us to have low cost all year round during high season and low season included. Overall, we managed to have quite 3 correlated lines. However, if you look more into in details, our expenses are not correlated to our occupancy and revenue, which allowed us to create more revenue on high season. We also increased our services expenses right before summer, as wished before high season in our initial analysis, and we kept it overall constant until many groups came in March of year 2.
So as for the guest satisfaction, looking at the guest rooms, because of the contract cleaning took place in February of year 1, there's a peak in March and the valley in August, which was due to the gradual increase in occupancy, which means more rooms are being used, leading to a lower satisfaction and more renovations is needed. For public spaces, we try to maintain a relatively good reputation for our guests with contract cleaning and services and self-reduce instead of renovations. As for facilities, we gradually add more facilities to our property, and most of the additions are done in September of year 1, which also contributes to a steady service satisfaction among our guests. And lastly, as for the service part, we could see that the guest the guest satisfaction is continuously growing and peak starting from March of year 2 because of the addition of Transport 1 going from hotel and the airport. We became a full-service hotel, differing from our initial strategy.
And for the marketing and advertising, at January to July year 1, there's a significant increase in marketing spend, peaking in July year 1 at around 50,000. We aim to increase more than 4% in occupancy rate monthly and invest more on the group advertising compared with other segments. There's a slight decrease in spend occurs in August year 1, going down to 47,000. At the September year 1 to January year 2, the spend stabilized at approximately 39,000. Starting from February year 2, with a spend of 36,000, which continues to grow slightly each month, reaching 37,000 by July year 2. And we can see the correlation between the amount we spend on marketing and the percentage in revenue projection, as well as with the occupancy rate. So the marketing have positive impact on attracting the guests, and when we reduce the marketing, it may reduce to a lower occupancy rate. They are proportional.
Let's begin with the shining star August year 1. It stood out as our best month for several reasons. Firstly, our occupancy rate increasing, slightly successful room sales. The surge in occupancy was complemented by the increase in both ADR and RevPAR, showcasing our effective revenue management. Moreover, our GAUTHIER indicating efficient conversion of revenue into profit, showcasing exceptional operational performance. The success in August year 1 was a result of strategy in pricing and sales channel management. By slightly underpricing against competitors, especially for transient rate, we attract price-sensitive guests while maintaining profitability on discounted and group rate. Now it's turned to our attention to April year 2, our lowest performing month. The metrics indicate notable drop in occupancy, especially in premium and standard rooms. This decline suggests a potential misalignment between price and perceived value, or perhaps the customer expectations. RevPAR and GAUTHIER was notably lower compared to other months, which issued with pricing strategy or difficulties in attracting guests. It's possible that our competitive positioning fell short against rivals offering more attractive rate or superior service during this time.
And here are the 3 important decisions we made. The first one, the increase on the investment on refurbishment in June year 1. Here's the significant increase from 72% to 78% due to the refurbishment enhance the guest experience with modernized public area and eco-friendly initiatives. And secondly, the continuously increase in marketing brings more net profit. From March year 1 onwards, both marketing investment and net profit show an upward trend, suggesting a positive correlation between marketing invest and net profit. And the third one is increase in weekday in marketing spend in April brings occupancy. The introduction of the OTA marketing spend in April year 2, although modest at 700, but coincide with the rise in occupancy.
For the short term, we aim to increase the overall revenue for our hotel by increasing our occupancy rate. On the occupancy standpoint, the occupancy rate in year 2 is lower than year 1. This might be due to the lack of advertising and marketing during year 2. As our year 2 revenue experienced a decline, the advertising expenditure also decreased. While the marketing costs represent 5% of our total expenditure during the November year 1, this proportion decreased to 3.45 in year 2. Consequently, the occupancy rate was impacted from 72.8% in year 2 to only 49% in May. Furthermore, the feedback also shows the ineffectiveness of our hotel marketing. In addition, as July and August as our peak season, we aim to increase the marketing expense to over 5% to increase the occupancy rate. Also, to maintain our high RevPAR and ADR. For the long term, we plan to transition from the business hotel to a more leisure type focus. Since the business center we built didn't really make much revenue, So it's better for the hotel to change the brand identity. And this approach aims to not only increase our overall revenue, but also elevate our profile in the various aspect. And the restaurant and the spa cost is 1.8 million. So we have to gain more revenue to increase our occupancy rate and maintain our RevPAR and ADR, since it is one of our advantages.
Many thanks for having listened to us during those 20 long minutes, and we wish you a Merry Christmas from all the Hotel Business 7 team.